Welcome to the Stockscores Market Minutes for April 19th, 2014. This week's topic, measuring the risk-reward, or what we often refer to as the reward for risk of trades. All traders should pay attention to how much they make for the risk they take on a trade. This is important, of course, because you don't want to take trades where you're risking $1,000 to make $200. You'd have to be right far too often to make money with that sort of approach. Ultimately, we want to make more money on each trade than we risk. Now you can plot the risk-reward on Stockscores charts. I'll show you how to do that in just a moment. You can also use the Stockscores risk calculator to help you understand the reward for risk you earn and size positions accordingly. Let's jump over to the Stockscores website now. Here I've got a chart of Canacol Energy, which was one of the stocks I featured in the newsletter last weekend. You can see here the chart is up. It's a 8-month chart. But what's important to note is that if you go down below the large chart, there's a bunch of tabs there. If I click on the chart tab, at the bottom of the chart tab, there is this place where you can enter in the information necessary for risk reward. We can enter in our entry price. Let's put in $7.40. We can enter in a stop loss price. We'll put in $6.95. Then click on Create Chart. And you now see that there are lines drawn on the chart representing the entry price at $7.40, the risk per share of 45 cents based on a stop at $6.95, and the current closing price at $8.06, which is representing a gain of about 1.5 times risk. The first line is 1-to-1. The second line is 2-to-1. What that means is that right now, if we risked $1,000 on this trade, our current profit would be about $1,500. And so we're sitting at about a 1.5-to-1 reward for risk ratio. Now, if you go into the tools area, and you have to be a member of Stockscores to do this particular function, to draw the lines on the Stockscores charts, that's free for anyone to use. But to use the risk calculator, you need to be a member of Stockscores. And here I can go in and also enter in some of that information. So I can put in a entry price of $7.40, a stop loss price of $6.95, and say that I want to risk up to $500 on any one trade with $10 in commissions. Click on Submit, and it will tell me that I can afford to buy 1,089 shares, which we would round off to 1,100 shares. Now on the right-hand side, we can put in, okay, we bought the stock at $7.40, or pardon me, we bought 1,100 shares at $7.40 with an exit price, well, let's use today's close price of $8.06, and a stop loss price of $6.95. Commission, again, $10. Click on Submit. And now we can see that our current profitability is up 1 to 1.467, or as I said, about 1 to 1.5. So that's a great tool to use on the Stockscores website for reward for risk, whether you want to plot it on the charts or use the risk calculator to calculate position size and your overall reward for risk. Let's get into this week's analysis. Here is the chart of the S&P 500, a 3-year weekly chart. You can see that we've got a nice upward trend. We were tickling through that trend last weekend, and that's why I had lowered my rating to neutral on the SPY. It has held the upward trend line, so I'm back to bullish as the long-term trend line has remained intact, and therefore we must remain bullish. Now, the market still has work to do. It could form a falling top and break that upward trend line. Certainly we've had 5 or 6 weeks here of sideways trading in the S&P, and that's somewhat worrisome. But given the gains that this market has enjoyed since the start of 2013, it's quite reasonable that the market take a little bit of a break right now. Ultimately, if the S&P 500 ETF, SPY, can break through that 190 level, the upward trend resumes and we are maintaining the bullish trend. All right, let's go and take a look at the TSX. Again, this is a 3-year weekly chart. We consolidated sideways under long-term resistance, which I have drawn in red. That's really normal. The market came up to some old highs and it got stuck there. That happens often. This week, however, we saw pretty good gains in the TSX, and that has the market breaking to a new closing high going back a number of years, and that is a bullish signal indicating that the TSX is likely to move higher and I expect it will outperform the US market, largely on the strength of the energy sector, which is the hottest sector right now. TSX Venture tried to sort of recover over the last few months. We sometimes joke that it's had a 2-month bull market, which is hardly anything given the length of the bear market, but it is holding up after those gains that started late last year, and it looks to me like it will probably resume. It's got lots of upside potential still. It's just taking time to get the confidence of investors back, and as I said, that does take time. We've had a very long-term downward trend in the TSX Venture, but I like the longer-term picture for these stocks, particularly if energy continues to be strong. That's going to trickle down to some of the smaller speculative stocks that make up the energy component of the TSX Venture, and I think it can help this market continue to recover. The biotech sector was the hottest sector for a long time, and it really became too hot. You can see that January, February, the Biotech Index Fund ETF, IBB, really ran parabolic up and away from its trend line, and that sets up for a likely pullback. Well, of course, we've endured a 2-month fairly sharp pullback in the biotechs, but that index is now back to its long-term upward trend line where it should stabilize. Now, I'm not sure that it's going to move to new highs all that quickly. Anytime you get a parabolic trend and a correction, it often takes time to build back some confidence. So I think if anything, we're seeing some stability here, and that's going to help the US markets because they needed that stability from this sector. The TLT, which is a representation of US Treasury bonds, was lower this week, which means yields were slightly higher, and that's really indicative of the stock market stabilizing. A lot of money was moving into Treasury bonds as a safe haven while the market corrected, and the fact that the SPY held its upward trend line means some of that money is coming out of Treasuries and back into stocks. Now, we can't ignore, however, that the 4-month trend in Treasuries is up, and we still haven't hit the long-term downward trend line. So I do think we could see a little bit more gain in the Treasuries before the sellers get aggressive yet again and drive interest rates higher. US dollar in a downward trend. It is bumping up against that long-term downward trend line that's been in place since the summer of 2013. It has more downside until it gets to important support levels. I've drawn that in green, and so my outlook remains bearish for the US dollar. Gold is trying to break that long-term downward trend line. You can see that 6 weeks ago it hit the downward trend line and got stuck, and that brought out the sellers, which we have experienced in the gold mining market. However, what I do note is that there is the formation, or at least the beginnings, of a head and shoulders bottom. You see the left shoulder in July, the head in December into January, and now the right shoulder building a rising bottom. If the gold market can break that long-term downward trend line, I will get bullish on gold. However, for now, we must remain bearish. There is some short-term optimism trying to build, and we should certainly pay attention to that, but we still have to take a relatively bearish outlook on gold. Oil market is in a long-term sideways trend. You can see that since 2011, oil prices really haven't gone that far. Certainly in the last few weeks, oil prices have gone up, but in the big picture, they remain stuck in that long-term pattern. I do like how oil is firming up and the effect it is having on energy stocks. The energy sector is enjoying a rotation as money moves out of some of the high flyers in the US and into the energy sector. However, the energy sector has been bought pretty aggressively the last few weeks, and it is due for a pullback. So my long-term outlook for energy stocks is bullish, but don't be surprised if we get a little bit of profit taking in the short term in that sector. Well, fear is always something that we want to keep an eye on, and in this recent correction, we didn't have the sort of jump up in fear that we would expect given the pullback in stocks. And that told me that the market was still relatively healthy, that the selling pressure was more a matter of profit taking than it was fear-based selling. And you can see over the last 3 trading sessions, the VXX has fallen back. We continue to have falling tops on this chart, and therefore fear is becoming less of a factor in the market than it has been. So my ratings then: bullish on the long term for US stocks, neutral short term as it grinds its way sideways, bullish on both accounts on the Canadian stocks. I do think the Canadian market will lead. Gold neutral as it tries to break that downward trend line, but it does have work to do. And neutral long-term on oil, but bullish in the short term. U.S. stocks are bouncing off of the long-term upward trend line, indicating the pullback may be over. Canadian stocks breaking through long-term resistance and are likely to go higher. Energy stocks strong, while gold is working to overcome long-term pessimism. Well, that has been the Stockscores Market Minutes for April 19th, 2014. Have a great week in the market and trade well.